and it really goes to the difficulty that our society has guaranteeing very, very, very large amounts of deposit with relatively limited pools of capital. It seems like people do more due diligence buying a pair of sneakers than they do before they put $250,000 in a bum bank. And I hope that that changes over time.
We're lucky to be joined by a legendary investor and speculator, Rick Rule, founder of Rule Media and former CEO of Spot US. Welcome to my show. Rick, always a pleasure to speak with you. I hope you're doing well.
David, the pleasure is mine. Life is very good. Thank you for having me on.
A number of things we need to talk about that investors are wondering about, and the first being the banking crisis. Jamie Dimon, CEO of JP Morgan, has said earlier today on Tuesday that he believes the banking crisis is not yet over, I believe were his words. Is he correct?
I think he is correct. I'm not trying to say that this becomes the full-blown crises that many people have been forecasting, but I will say that the sins in the banking industry, as you and I have discussed over the years, actually, is not over. I read with some interest a report that's circulated fairly widely on the internet that suggests that 156 different banks have, if they were to mark their bond portfolios and their loan portfolios to market, would have liabilities that exceeded their tangible book assets. So the idea that the sin with regards to borrowing short and lending long has been exercised from the banking system, I think is a mistake. I think that the Fed has acted very quickly, in some senses, probably excessively, to maintain confidence in the system. I grew up in an era that suggests that when you make mistakes, the shareholder should be punished. And I'm a little concerned, more than a little concerned, actually, about that sort of moral risk around bailing out the shareholders of certain institutions. But I believe, at least for the time being, that confidence in the system has been maintained. I'm a bit distressed, too, that depositors have decided to concentrate their deposits in the so-called too big to fail banks, including, ironically, depositing money in checking accounts with the big five banks that pay absolutely no interest. I think the root of the problem that we have today is that depositors and investors have decided to outsource due diligence to the federal government. We have seen that that doesn't work, but the policy continues. My hope is that depositors would begin to do things like read the statement of financial condition of the banks that they deposit in. It seems like people do more due diligence buying a pair of sneakers than they do before they put $250,000 in a bum bank. And I hope that that changes over time.
Rick, do you watch South Park by any chance?
Sadly, David, I'm not much of a social media guy. I have a TV now, but I don't know how to turn it on. So no.
It's it's a cartoon, and there's a scene there that reminds me of what you just said. So a young boy goes to a bank and he has $100, and he says to the teller, "I have a $100 check that my grandmother gave to me as a gift. I'd like to deposit it and watch the money grow." And the teller says to him, "Great idea, young man. We can certainly do that. Let me put it into a money markets fund and investor for you. And over time, it'll grow. And whoops, sorry, it's gone." Boy looks at him. What do you mean it's gone? He says, "Well, markets didn't do too well. It's gone. By the way, do you have an account with us? Because this line is for bank account holders only." And he says, "Well, yeah, I just opened an account. You lost my money. So you don't have an account with us. You have to move aside." The point I'm trying to make with this facetious example is that people would like to know whether or not a bank is safe. But most people most of us don't know how to read financial statements. And so if you could just point us in the right direction and tell us maybe your top 2 or 3 metrics that you would look for when evaluating the safety of a bank for a depositor, that would be much appreciated.
The banks are required on request to send you something called a statement of financial condition, which is sort of a short form set of financials. I would look at book equity. which is to say the equity slice that in effect secures your deposits. The FDIC suggests that 7% of total assets by way of equity is well capitalized. I prefer a number in tier one capital or core equity that begins with 10, a double digit number. In other words, make sure that the bank that you deposit your money in has some of their own money in place. The shareholders' capital is designed to allow the bank to withstand tumultuous times like these. And the more capital in front of your deposit, the safer your deposit is. The second ratio that I look for is cash and cash equivalents in the bank relative to demand deposits or now deposits. To the extent that banks have a lot of deposits that are longer term, that is to say, deposits that are sticky, that have 1 to 5 year duration to match the durations of the loan, that's okay. To the extent that banks have a lot of very low cost checking or now deposits that are short term, if they've lent long, that's not okay. The bank needs to have enough cash or cash equivalents that they can afford a period of disintermediation. Disintermediation meaning people taking their money out of now accounts and putting them in other instruments. The third ratio to look at, and this is a bit trickier, but you can ask the bank to provide it for you, and good banks will, would be the mark-to-market value of their portfolios, which is to say, if you have a bank that's lent long, bought collateralized mortgage obligations, say with a 5 year term, and they funded that with now deposits, that bank has a problem. They have a problem when the interest rates went up for 3 reasons. First, they are paying much more to fund that loan today. Their loan margins have shrunk. At the same time that the capitalized value of their distributions has declined, and they have that classic mismatch between assets and liabilities. So those are the 3 things that I would suggest that depositors look at. This probably takes 5 minutes, but most depositors think there's a lot of arcanery involved in bank balance sheets, and there can be. But if you pay attention to those 3 simple tests, first of all, you'll be out competing about 98% of your competitors across the length and breadth of the country. And secondly, you will be participating in a process where you're taking control of your own financial future rather than consigning your financial future to a bunch of politicians who have proven to be incompetent to do so.
And I think part of it has to do with the fact that depositors feel that their money is insured. And certainly the FDIC has insured up to a certain limit for most people. Janet Yellen, Secretary of the Treasury, has recently stated that the Treasury Department and the U.S. government would help depositors if, in case, another Silicon Valley bank were to occur. And so why bother going through all this due diligence is my rhetorical question to you, Rick. If my money is at least partially insured up to, I think, $250,000 per the FDIC.
I think, remember that I said think as opposed to know. I think that the FDIC can weather this storm. I think there is enough solvency left in the U.S. economy to handle wobbles. I note that the aggregate mark-to-market losses in the U.S. banking system exceed by a substantial amount the money currently available to the FDIC to solve the problem, which is to say that if all of the banks had to mark their losses to market, then the amount of money available to the FDIC to solve the problem is very, very insignificant. The total deposit liabilities in the U.S. banking system exceed $14 trillion. The money available in the FDIC to solve the problem is several $100 billion. I'm not trying to say that a bank run of the magnitude necessary to overwhelm the FDIC reserves is in the cards. What I am saying is that I would prefer myself not to have to worry about it. I would prefer to have insured deposits in banks that are already solvent. We should talk about mark to market because many people won't know what that term is.
Yes. Can you please help us define that? Yes.
Banks can account for their bond holdings in two different pockets. One, available for sale, which is to say that the bank is storing money in these bonds temporarily to earn interest on those instruments until they could redeploy it. And in accounts where the securities are held for sale, those securities need to be marked to market. If you own a long bond and the interest rate rises, people can buy new issuances of security to earn the new higher yield. So on the older securities, they get marked down in the market. When banks have bonds, longer term bonds, issued and denominated in the same currency that the bank reports in, if the bank says that they intend to hold these securities until maturity, they are not forced to mark them to market. And if you look at what's happened in the last 3 months, a bunch of bonds and a bunch of banks that were, quote, available for sale have been transferred into an account that says hold to maturity, which is to say that the mark-to-market liability on many of these bonds has been disguised through what I would describe as financial sleight of hand by the banks. It may be that if they have access to deposit liquidity or if they have access to the Fed discount window, that they will have sufficient liquidity that they can maintain these bonds in the held to maturity category. But the truth is, it really truly is financial sleight of hand. And it really goes to the difficulty that our society has guaranteeing very, very, very large amounts of deposit with relatively limited pools of capital.
This goes to our next question, which is which banks you would think in today's environment would be quote unquote safest, relatively speaking, for a depositor. One of the things that I guess people look at is a Tier 1 capital ratio, which measures the amount of equity per their risk-adjusted assets. And so I'm looking at this list, and the biggest banks in the U.S. that have a Tier 1 capital ratio of above 6%, which is, I believe, what's required by the Basel III Accord. You have J.P. Morgan, Bank of America, Citibank, Wells Fargo, Goldman Sachs, TD, Morgan Stanley, Charles Schwab, so on and so forth. And, these are big banks. They're not your regional community banks. The question then, I guess, would be whether or not community banks and regional banks have a future.
I think they have a very bright future. When I look at all the banks that you just mentioned, I personally, despite 45 years of experience, don't understand their balance sheets. And when the regulators are doing the risk calculations, I don't see anything in those risk calculations, as an example, for either Bank of America or Charles Schwab with regards to the mismatch between durations. Both organizations have switched large amounts of bond holdings or mortgage obligations from available for sale to held to maturity. It probably works, but I don't want to have to think about probably, David. I have no interest in that. The second thing that scares me about the list of banks that you read is that many of the banks on the list that you read have very, very, very large, at least nominal, derivatives exposure. They would argue that their net derivatives exposure is much lower because they've sold both the long side and the short side of the derivative. They stand in the middle. That nominal exposure becomes less real exposure only if both sides pay. I don't know enough about their derivatives book, but I do know that if you are trying to, in effect, insure as middleman $20 trillion of derivatives exposure with an equity slice that's less than 1% of that amount, that you need to be an awful lot smarter than I am to make that transition work in a circumstance where there is as much turmoil in the market as there is today. I'm not trying to be a doom and gloom guy. What I'm trying to say is that for depositors, particularly depositors of my age, or they can't get it back. Put your money in banks that have money in them. If you want to put them in a big bank, you'll be happy to hear this as a Canadian. Royal Bank of Canada is probably not a bad selection because of their relatively small derivatives exposure, and because of their very, very strong equity as opposed to tier one capital slice. I have money in some regional banks that are well capitalized. Depositors might look at First National Bank of Alaska, a fairly obscure bank, Farmers and Merchants Bank of Long Beach, another obscure bank. Uh, I look for banks where tier one capital is in excess of 15% of total assets. I don't deposit any longer in amounts more than $250,000. If you have more than $250,000 on deposit, it's very easy to open up a Treasury Direct account and buy U.S. Treasuries of 180 days duration or less, which is probably a better alternative. The Fed, unlike any of the banks, can simply print their way out of the obligation.
Yeah, it was a colorful quote you gave me a while ago that changed the way I think about the central banks. I think you said that if the Federal Reserve or an everyday person, he go to jail for theft. I'm paraphrasing what you said, but I think that's kind of the idea. We can talk a little bit about the Federal Reserve in just a bit and their policy. My last question about banks, Rick, is how you think the banking crisis will unfold. I've heard the opinion that perhaps the government may encourage more consolidation between banks, and perhaps more mergers may be encouraged by the government. We saw what happened with Credit Suisse and UBS. That could be done on a wider scale in the U.S. Do you think that's one solution, if you want to call it?
I do think it's one solution. I would urge depositors to look through the length and breadth of the banking area to find where to borrow money from and where to deposit with. I don't think the solution is a wholesale exodus to the big banks, particularly when the big banks, at least on your checking accounts, don't pay you any interest. That seems very, very, very silly to me. I think the immediate implications are that there's going to continue to be more uncertainty and more turmoil in the market, which markets don't like. I think, too, that this will ripple through to the broad economy because I think that credit will become less available. I think you have a banking industry that's trying to repair their own balance sheets, and you have a regulator which wants them to repair their own balance sheets, which means that many lending activities will slow down. And I think that the reduced availability of capital and the higher real cost of capital will have implications through the real estate industry, through private business, and through public companies. I'm not saying that we're going to have a full-blown liquidity crisis, but I think the circumstance that we've existed in for the last 40 years, with a couple colorful interludes, is one that's over. The period of lower interest rates and the period of increased capital availability. I think we have to go through a period now that's a bit of a tumultuous period where there is concern in the market about perhaps not the solvency of the system, but where business as usual has changed. And I think in particular for borrowers across the spectrum, other than the largest and most creditworthy on-balance sheet prime rate borrowers, that we're going to come into a period for 3 to 5 years where there's less availability of at least cheap capital.
Speaking of markets performance, the markets certainly share your sentiment today. JOLTS data came in, and vacancies were higher than expected. I think vacancies at U.S. employers fell to 9.93. I'm sorry, they were lower than expected. 9.93 from 10.5 million, lower than expected. And the jobs market seems to be on paper softening. This has put, I guess, worries in the stock markets. I'm wondering why the stock markets would interpret this as bad news. Jerome Powell, Fed chairman, did say that he would need the job market to soften for interest rates to come down, well, before he even considers the idea of pivoting, right? So I'm wondering why the stock markets are reacting negatively to, I guess, poor labor data.
I think the stock market, well, the stock market reflects a whole bunch of concerns, a panoply of concerns. In the very near term, a weaker jobs market would suggest that the Fed has room to cut interest rates, which would be good in the near term for the stock market. Real investors, of course, look at the longer term, and the mismatch between opportunities and job seekers is a continuing problem. There are lots of job openings where, unfortunately, the utility offered up by the job doesn't warrant a living wage. It's a truism that somebody who is hired to flip hamburgers at the minimum wage can't afford to eat those hamburgers. And that points to a bigger problem in society. There are also something like 6 or 7 million jobs that American industry is looking to fill where they can't fill them because there's a skills gap in the population. And I think in the longer term, investors are looking at the labor market, looking at the inevitability in a period of inflation, of wage inflation, something that we haven't seen in the country for about 40 years. And at the same time, looking at the inability of the labor market to fulfill the need, as an example, in jobs like skilled trades or in certain professional classes. And I think that has implications, fairly broad implications, for the performance of the U.S. economy in the 5 to 10 year time frame. So the data that you see is mixed. In the very near term, yes, a weaker jobs market can allow the Fed to soften up the march of interest rates. In the longer term, the twin mismatches in the labor market point to increasing turmoil in terms of the performance of the U.S. economy over time.
All right. I want to shift gears and talk about commodities now, which I know is a asset class and topic that you've forgotten more than I know about since the beginning of this conversation. And so you were the right person to ask about how commodities affect our economy, and in particular inflation. Inflation has been coming down on paper, Rick, and you see a correlation between the CPI and the energy price, in particular crude oil, also been coming down over the last 6 to 8 months. I know correlation, not causation. Is there a causation, is my question.
I don't think that the increase in interest rates, as an example, has been responsible for a decline in the oil price. I think what's been responsible for a decrease in the oil price is the fact that markets work. The impending scarcity of crude around the sanctions against Russia and the relative strength of the global economy, I think, caused the oil price to soar. The response to that very high price was two things: conservation, which happens during periods of high prices. People on the margin drive less, as an example, because it costs more. And flat out drilling, particularly in the Permian Basin in the United States. Markets worked. The cure for high prices was high prices. The cure for low prices will be low prices too. The fact that the Fed or any part of government tries to take credit for lower energy prices is facetious, but that doesn't keep them from trying, of course, to make it. I note with some amusement that OPEC has announced a 1 million barrel cut when many of their members were already producing below allotment. One of the things that you see with regards to relatively high oil prices that we've enjoyed, if that's the right phrase, for a year and a half, has been the fact that despite the industry generating very high free cash flow, estimates suggest that on a global basis, the energy industry has been deferring $1 billion in sustaining capital investments a year. In some countries, Nigeria, Venezuela, Mexico, Indonesia, this deferral of sustaining capital investments has already begun to seriously impact their ability to produce. They aren't producing up to their quotas, not because of any discipline, but rather because they can't. They haven't invested enough money in the maintenance of production. And this is something that we need to face as consumers and as investors. The schizophrenia of oil markets around politics is something that will impact everybody who's listening to this at the pump. President Biden, as an example, suggests that the oil industry needs to trim its margins after a couple of years during COVID when they had negative margins, not much to trim. He suggests that they need to increase production to lower gas prices, while at the same time saying, as a consequence of his policy, he's going to put them out of business in 2030. Now, how much incentive do U.S. oil and gas companies have to drill like mad when the executive says he's going to put them out of business in 6 years? The consequence of that is that the oil industry is returning large amounts of capital to shareholders and not making sufficient sustaining capital investments. What this means is that crude oil prices will be higher for longer. David, I'm not one of these who is a climate denier. I'm not one of these who believes that we should continue to pump stuff into the air and stuff into the water. What I am is simply a guy who's pretty good at arithmetic. I'm a guy who looks at the fact that we spent over $4 trillion in alternative energies, and we've reduced the market share of oil and gas from 82% to 81%. I'm a guy who understands that peak oil demand will occur in 2045 or 2050, and the tail off for 40 years after that. The consequences of policy, the consequences of the economy, and the consequence of systemic underinvestment in oil and gas means it's going to be a better business for longer. Politicians, consumers, savers, and investors all need to understand that.
I do want to ask you about alternative energy, which I believe is the theme of one of your upcoming conferences, Rick. But first, I want to draw your attention to the natural gas chart, which is currently at around $2. It was at $10 several months ago, about a year ago, which is an 80% decline. So it's now trading at about 2021 levels. So my question is, how much of this rise that we've seen over the last year was artificial? In other words, not really in line with the equilibrium price of the market because of Russia and Ukraine. And do you think that this decline in natural gas will likely continue and perhaps bring down energy consumption prices in America and beyond?
Certainly in the very near term, energy costs are going to fall substantially, which will be very useful for the Fed, by the way. They'll be able to take credit for taming inflation when lower energy costs will be the reason. They'll happily smile and say, we did our job, of course. Your bigger question reverts back to one of my old answers. The cure for high prices was high prices. The cure for low prices is low prices. At $2 a thousand, or put differently, $2 per million BTU, many standalone gas wells don't make money. What makes money is byproduct gas that's produced as a consequence of producing oil. And you will see very little gas-centric drilling, particularly in the United States. The second thing that you'll see is increasing consumption of export facilities, because the price of liquefied natural gas in Japanese markets, Chinese markets, and European markets is still at double digits. So you have $2 Gulf Coast gas prices and $10 liquefied natural gas prices in Rotterdam. This is way, way, way too big an arbitrage not to be addressed. We've experienced, I think, an increasing globalization of the natural gas trade, particularly as a consequence of the Russian invasion of Ukraine. But markets do work. This big arbitrage will, at least in the United States, trigger a big debottlenecking of transmission facilities and trigger an increasing amount of liquefaction plants, particularly on the U.S. Gulf Coast. It remains to be seen whether or not Prime Minister Trudeau will understand that there actually is a business case selling Canadian gas for $10 per million BTU as opposed to $2 million per BTU. If, in fact, the Canadian taxpayers remind him at the polls that there is a business case for that, then Canada can participate in this too. It's ironic that the best promoter of the U.S. oil and gas business is the Prime Minister of Canada.
Well, we'll be sure to send him a note up there where I am. everyone mail in a letter to Prime Minister Trudeau with what Rick just said. Rick, I do want to bring your attention now to the battery metals. I believe you have a battery metal conference or boot camp coming up in a few weeks. So tell us about that conference. And my broader question towards the battery market is whether or not you think that battery metals will replace, not so much replace, but serve the same utility as crude oil in our society in the not too distant future.
Here's what everybody misses, David. There's 8 billion of us on Earth, and there's more every day. 1 billion people on Earth, David, have no access to electricity at all. 2 billion people have access to unaffordable or intermittent electricity. And even those of us who live in the Western world and by global standards live very well are increasing the energy density of our lives. What that means is that we need more of all forms of energy and electricity. Wind, certainly where the wind blows. Sun, certainly where the sun shines, but not in Germany where the sun doesn't shine. Geothermal, yes. Oil and gas, yes. Nuclear, yes. Coal, yes. Yes to all of it. That's what people don't understand. Yes to all of it. Yes to all of it for a fairly long time. I am delighted with the progress of humankind through technology, the ability to bring electricity to 1 billion people that don't have it, the ability to allow the 2 billion people on Earth that experience energy poverty to live a more energy-dense life. The consequence of that, I think, is that demand for the materials that facilitate this is going to grow pretty dramatically. Absent, and your listeners should mark this down, absent a global recession or depression. The reason that I think that the energy metals will do so well isn't merely a function of demand, but rather supply. I would argue, David, that over the last 30 years, that humankind has underinvested in exploration. It's underinvested in development. It's underinvested in new mine construction across a broad range of materials, but that includes things like copper, zinc, cobalt, and nickel, vanadium, a whole range of materials which are necessary for this ongoing energy transition. If we have a recession, you can have declining supplies being a function of insufficient investment. But if we don't have a recession, if we don't have a depression in the next 5 years, I think that you're going to experience fairly dramatic shortages of many of the energy materials, and as a consequence, higher prices. Let's look at the big one, David. Let's look at copper. I would say that I'm an icon for copper mines. I'm 70 years of age, which is to say well past my prime. Look at Bingham Canyon, the biggest copper mine in the United States, 160 years old. Highland Valley, biggest copper mine in Canada, 75 years old. Chuquicamata, biggest copper mine in Chile, 115 years old. Grasberg, 60 years old. Even the newcomer, Escondida's 40 years old. To replace these old behemoths is going to take lots and lots and lots of new productive capacity for copper. To build a big copper porphyry anywhere in the world requires years of permitting and somewhere between $5 and $10 billion. So absent a recession or depression, in the biggest, most liquid energy metals market in the world, the copper business, we face shortfalls in the 5-year time frame, and not just shortfalls, but rather dramatic shortfalls. I think that investors who believe this narrative need to understand each market, each metal market individually, and that's why we're doing this boot camp around energy materials.
You've presented an excellent bull case for these critical metals, but I would dare say a bear case for society at large. If we were to face dramatic shortages in the future with these materials that we desperately need for this energy transition, what are we going to do as a species, Rick? Sounds like we're in a bit of a pickle.
I mean, markets do work. We will slow down energy transition. If emerging markets, as an example, if China becomes more rich on a GDP per capita basis, let's just say starkly that they will compete well with the United States, with Japan, with Canada, with Europe for supplies. If they don't, our energy future will be brighter than theirs. We saw once before in the decade of the 1970s a circumstance where society's underinvestment in raw materials and competition between societies for raw materials and inflation necessitated in the market higher prices. And we saw the incredible dislocation that that competition caused. Is past prologue? I don't know. I mean, I really don't, David. I'm not conversant enough to understand the policy implications. I can say this: the utility of copper is high enough that if humankind had to pay $7 a pound for copper rather than $3.50 a pound for copper, that we would accommodate ourselves over time. It would create a lot of angst. And what I think you would see is, over time, the genius of humankind working its way through the fabrication process to use less copper for certain applications and to substitute other materials like aluminum for wiring. In other words, I think it's a problem that will solve itself in the 5 to 10 year time frame. But I think also that the transition period, getting from where we are, a period of very cheap materials and ample supplies, to where we're going to be, which is to say equilibrium, will be tumultuous and pleasant for those people who speculate on it, unpleasant for those who haven't taken it into account in their fabrication or consuming plans.
Okay. Well, very good. Finally, you have another conference in July, the Rural Symposium on Natural Resource Investing. Can you just briefly summarize one or perhaps two of the major themes of natural resource investing in this current decade that perhaps wasn't discussed already? I know that critical and strategic metals has been one of them. Is there anything else?
Well, I think there's two themes. Industrial materials, which I would describe in natural resources as everything except gold and silver, are necessary for the future of humankind. Demand for those things is assured by the growth in population and the growth in GDP. And I think that there's been a mismatch in the market between investment and anticipation of future demand. So I think that the 5 to 10 year future in those materials is great. I think, too, that we're seeing a fundamental shift in savings and investment products, which I think comes to favor precious metals and gold and silver. I think investors need to learn more about them. I'm amazed to note that the market share of gold and silver, precious metals and precious metals related securities, relative to other savings and investment products in the United States of America is at 0.5%. The 4-decade mean is about 2%. If things like negative real interest rates, a banking crisis, debt and deficits aren't enough to inspire investors to increase the proportion of precious metals in their portfolios from 0.5% to 2%, I would be very surprised. Gold doesn't need to win the war against the U.S. 10-year Treasury. It needs to lose it less badly. And if the market share of precious metals reverted to mean, demand for precious metals in the largest savings and investment market in the world would quadruple. And that's precisely what I think is going to happen. So the thesis for the conference is that most investors are underinvested in natural resources and precious metals. And those markets seem like an inevitability. Rather than go into chapter and verse, I would suggest that people click the link to go to the conference and understand this. In the boot camps and in the conference and in every other investor education product I've sold for 30 years, anybody who pays the tuition for one of my courses and doesn't feel like they got their money's worth has an ironclad money-back guarantee. If you go to the conference, spend 4 days of your life learning about investing in natural resources, and you don't think that you got your money's worth, I'll give you your money back. If you attend my online boot camp for 8 hours and don't think you learned enough about electric and battery metals to justify the $99 tuition, I'll give you the tuition back. And by the way, with regards to the live conference in Boca Raton, if it's inconvenient for you to come down there, we're going to live stream the conference. and you'll be able to have access to all of the information at the conference in your home, on your computer, and you're going to have access to it for the next 6 months.
Okay, so I'll put those links in the description down below. How would you convince a young person, a person in maybe their 20s and 30s, to go to one of these resource investment conferences instead of a crypto conference, many of which are happening throughout the summer around the same time? It just doesn't seem like it's, if I may use the word, a sexy investment for younger people. No, regardless if it's important to our society as a resource. But I'll let you answer that.
I wouldn't discourage a young person from going to a crypto conference. I would say for young people, the most important investments they can make is in themselves and in their own education. I don't think that they're mutually exclusive. I don't think that the utility around crypto is the same as the utility around natural resources and precious metals. In a crypto investment, I think you're investing in several things. One is the network. I look at the lack of tangible value in crypto, and that's one of the things that scares me about it. The second is, of course, the volatility in crypto. The same thing that attracts people to speculate in crypto, which is to say the rapid price movements, is damaging to crypto's utility as a medium of exchange. If you buy a sack of groceries for a fractional Bitcoin, you don't know what you paid for the groceries, and the merchant doesn't know what he or she received. And that very volatility, I think, reduces the so-called frictionless or low-cost function that crypto was supposed to fulfill. So I'm not suggesting that young people don't attend a crypto conference to the extent that they believe that the network effect will continue to drive demand for crypto, or to the extent that they believe that they understand the sociological or technical implications of crypto. I think it's a different asset class. I think that young people who are good at arithmetic, who understand the inevitability of more people competing for supplies that have been constrained by 30 years of underinvestment, in particular, young people who believe that 5 years from now, when they go out to the garage and turn the key to the right, that the car will start, would like to be more educated about investing in natural resources. I further believe that young people who are concerned about the fact that my generation is spending young people's inheritance, that we're consuming our seed corn, that in the United States, the aggregate on and off balance sheet liabilities of the federal government, not just state and local governments, exceeds $100 trillion, and we're adding to that number by $2 trillion a year. If the arithmetic, if the inevitability of the government as it's currently configured to run out of resources doesn't scare people, doesn't scare young people, then perhaps they don't need to attend the boot camp. But I would suggest that people who aren't concerned in this circumstance can neither add nor subtract or, in fact, read.
On that note, we'll end it there. Rick, I really appreciate your thoughts. We've covered a lot of ground today, and we'll follow up again and touch base on where the banking crisis is headed and how the commodity markets respond to current macro conditions. So thank you very much for your time today.
David, thank you, and thank you for a well-thought-out series of questions. It was a pleasure.
Well, you make it easy for me. And thank you for watching. Don't forget to subscribe.